A COMEX default will lead to credit grinding to a halt. Credit grinding to a halt destroys the real economy. It completely blows up the financial markets. And when financial markets blow up, you're going to have some losers. I mean, derivatives are it's a closed game. There's only a winner and a loser. And if the loser loses so big that they can't pay, then the winner becomes a loser because they didn't get paid. Well, I would imagine while China is basically closed down, there won't be any trading there. You're going to see COMEX pull some tricks. It would not surprise me to see, whether it be 1, 2 days, 3 days, it would not surprise me to see a pretty big hit on gold and silver because you don't have the Chinese there to buy in the physical markets to stop COMEX from selling on that paper contracts. That's going to be a problem for them though, because when you sell something you can't deliver on, and there's a delivery, I mean, we are in the middle of a delivery month for COMEX silver. You know, what's going to happen at the end of the month? So they smashed silver this week, and I mean, that's just a guess of mine. But if they smash silver this week, and then China comes back next week, and we go into the first notice day on the 27th, that's going to be a big, big problem for COMEX. I mean, their days of pulling rabbits out of the hat are pretty much over. And I mean, there's a chance that they push silver and gold higher this week, but I don't think so. With China closed, you know, the mice are going to play when the cat's away.
What do you think of this notion or this idea that China may be incentivized to lower silver prices, given the fact that it's so reliant on silver, relatively more so than the United States is, because of their EVs and their electrification, right, their grid and all that other stuff?
Yeah, that's absolutely the case. And it's been the case, 30, 40 years, the price of silver has been suppressed. And I believe that the Chinese, they are realists. They understand that there's a supply-demand problem, and the days of cheap silver are gone and done. And just go back 2 weeks ago, I forget which minister it was out of China. Basically, they're telling the world that they're selling treasuries, U.S. treasuries, and with those funds, they've been buying gold.
Delivery months act as stress tests for futures exchanges. If significant silver stands for delivery, inventories must match contractual promises. Global silver demand currently exceeds annual mine supply by hundreds of millions of ounces, driven by solar panels, electric vehicles, and advanced electronics. A temporary price smash might suppress sentiment, but it cannot manufacture physical supply. Should large delivery requests collide with already tightening inventories, confidence in the paper system could erode quickly. Markets function on trust. If participants question whether contracts truly represent accessible metal, volatility may accelerate instead of subside, amplifying instability across related financial products.
I mean, obviously, the volatility from $123 has been downward to this, call it 65 to 85 range. I mean, even if we did not have a major delivery month for March, first notice date of February 27th, even if we did not have that as, a potential catalyst to actually smoke the market, to see silver just go sideways for a month, 2 months, 3 months, I mean, that would not be a bad thing at all, because the overbought has already been worked off. But you'd work the overbought completely off, and basically set up a new base for another run. And I think that Michael Oliver is absolutely correct, is that you're going to see triple-digit silver, possibly $200 or $300 silver by the middle of this year, based on the fact that there's there's a well-known supply and demand deficit, and it's almost 500 million ounces. The
So
world,
is this? Go ahead.
I was just going to say, the world has woken up to the fact that you can't use COMEX contracts for silver applications. You can't print silver, and that's the problem. First off, understand that there was a psyop, if you will, going back to 1971. 1971, when Nixon closed the gold window. There's been a psyop in the West: gold bad, dollar good. When I say dollar, I'm including, other Western fiat currencies. So there's been a concerted effort to steer people away from the safety exit, steer people away from gold and silver. Go back 25 years ago, you had central banks in the late 90s selling gold, and the headlines, people were always looking for headlines, which central bank is selling. And it culminated with the brown, they call it the brown bottom, in 1999, when when Britain sold, I think the number was 60% of their gold reserves at some stupid number like $286 an ounce. And that turned out to be the bottom. But there's been a concerted psychological operation on the Western population. That's one thing. Another thing is, the West has been wealthy for a long time. And you've seen a lot of selling, particularly in North America. You've seen a lot of Americans selling over the last 6 to 12 months. And the reason being, the cash flow is faltering. So people are getting squeezed. So what do? They sell what they can to continue their lifestyle, to continue life. So the West, the cash flow is failing, and you have people used to a higher standard of living, as opposed to the East. That's still a growing economic area, and you've got more and more people becoming middle class, upper middle class, wealthy, etc. And as they earn, they're thinking, well, where do I save? And it's pretty clear. All you have to do is look at fiat currencies since the last 20, 25 years, and they fully understand you don't save in fiat, you save in something real. And there's your demand for gold and silver. For gold primarily. Silver, the demand obviously is coming from all over the place, coming from the green deals, coming from industry, coming from the medical field, you name it. Silver's used. Militarily, technologically, silver's used everywhere.
China occupies a pivotal role in precious metals and industrial commodities. As the world's largest solar panel producer and a dominant EV manufacturer, it consumes enormous quantities of silver. At the same time, Beijing has steadily diversified reserves, reducing exposure to U.S. treasuries while adding gold. This dual strategy reflects economic realism: secure hard assets while supporting domestic industry. Lower silver prices would benefit manufacturers short-term, yet long-term supply deficits complicate that objective. In markets defined by scarcity, sustained suppression becomes increasingly difficult. Industrial demand ultimately imposes a floor beneath financial speculation.
And I'm on record when GLD and SLV first came out. I said that is a paper alternative to physical metal, and what that's going to do is it's going to siphon demand away from real metal, because they don't have to buy metal. They can buy contracts and say, we have all the gold. Contractually, we have all the gold. But contractually versus physically, there's miles and miles of difference. I said the same thing about Bitcoin and the other cryptos. Basically what they are is they're being shown as an alternative to fiat currency. So that brings in your buyers. But really what it's been has been an alternative exit from fiat currencies into gold and silver. So it diverted demand away from gold and silver, which would have blown up years ago, in my opinion, if it was not for the crypto assets. And when all is said and done, I think crypto is digital air, and I think they're going to pull the plug. Everybody's going to lose what they put into it. But what it did was it bought the powers that be time before gold and silver got completely out of their control. If you go back and follow Bitcoin, it's been story after story after story. And one of the stories was, oh, you got to do Bitcoin because it's private. Nobody knows what you're doing, which is complete, it's a complete lie. But it sounded good.
Yeah. And well, it's mainly also been used. They talk about Bitcoin being used. I don't want to make like a Bitcoin bashing episode, but just to kind of stay on topic here, they've also had they also bring up the notion that Bitcoin is also like used in drug trafficking, all this illegal activity. But
Sure.
I mean, who's the biggest drug trafficker out there in the world? It's the CIA, right? So I mean, hand in glove, right?
Yeah, I mean, go back to the Afghanistan poppy fields, or even before that. That's drug trafficking.
Yeah, I mean, money.
That's
If you
dark
wanted
money.
a mechanism to money launder, Bitcoin's the perfect mechanism, and who would be one of the biggest beneficiaries of that? I think we can all kind of connect the dots here.
I agree. I think the target date is mid 27.
Okay.
I could be mistaken on that, but I think that is the target date. And it wouldn't surprise me if we saw some fits and starts late in this year or early next year, because you can't just roll something out. You've got to roll it out, little by little. It's going to be tested. But I think the appetite for the BRICS currency is going to be huge at the expense of Western fiat currencies. And capital coming out of the Western fiat currencies means lower currencies, and also, by definition, much higher inflation.
Since the early 1970s, Western investors have largely favored fiat-based financial assets over tangible stores of value. Gold and silver periodically regain attention during crises, only to be overshadowed by new alternatives. Exchange-traded products and cryptocurrencies have absorbed substantial capital flows that might otherwise have entered physical metals. Whether one views digital assets as innovation or diversion, the effect has been measurable: demand fragmentation. Yet physical commodities differ from digital representations. Industrial silver cannot be replaced by contracts or code. When supply tightens, real-world necessity outweighs speculative narratives.
Do the best you can. When I say do the best you can, if you know what's coming, prepare for it. You do the best you can to make your preparations.
And in regards to what's coming, what exactly do you see coming? Are you referring to the credit event, the credit failure event?
I think that's mathematically a certainty. It's only a question of when that happens. But yeah, I mean, that is the big kahuna right there. Once credit begins to sputter or actually seizes up, that's going to affect immediately the real economy and the ability to get goods to market. And it will absolutely destroy the financial markets, because everything, most importantly, including derivatives themselves, rely on credit. And if credit becomes difficult to get, the whole system comes down, because by definition, when you're talking about a fiat currency system, a fractional reserve system, it is put together on the schematics of a Ponzi scheme. And a Ponzi scheme has to have new money come in at ever increasing rates. Otherwise, it gets exposed. And that's what will happen to the Western system. If credit becomes scarce or hard to get, then the entire system gets exposed as a failure. In other words, they have to increase debt. That's the only way to increase money in the system. But if you're already at debt saturation, how do you increase debt? And that's where we are. Well, you could see COMEX default in a week and a half. I mean, you tell me what the number is on February 27th,
Mm.
and I can give you, I'll just give you rough odds off the top of my head what the likelihood of a failure to deliver is. I mean, if I'm going to say right now, if COMEX has 100 million ounces or more standing for delivery on February 27th, I don't think we make it through the month of March. And if we do make it through the month of March, the COMEX inventories will be 100% crippled, and the next delivery month will be the next, not non-delivery, but primary delivery month. That will be it. Because they're already running, call it 40 million ounces per month in deficit. In other words, the world uses 50 million or 50 million ounces more per month than is actually produced. How long can that go on?
Modern financial systems are built on credit expansion. From derivatives to sovereign debt, leverage depends on continuous liquidity. A disruption in credit markets, whether triggered by counterparty risk, delivery failures, or broader economic stress, can cascade rapidly. Precious metals exchanges are intertwined with this architecture. If confidence in settlement mechanisms falters, ripple effects could extend beyond metals into broader equity and bond markets. History shows that liquidity crises rarely remain isolated. They reveal structural imbalances accumulated over years of compounding leverage within fiat-based systems.
What does this spell, though? I mean, everyone's sitting on the other side of the screen right now. What does this imply to them? What happens to their fiat currency? What happens to their stocks? What are the ramifications of the COMEX defaulting?
A COMEX default will lead to credit grinding to a halt. Credit grinding to a halt destroys the real economy. It completely blows up the financial markets. And when financial markets blow up, you're going to have some losers. I mean, derivatives are it's a closed game. There's only a winner and a loser. And if the loser loses so big that they can't pay, then the winner becomes a loser because they didn't get paid. And what happens is the losers, they go into bankruptcy, they default basically, and then you have what David Rogers Webb talked about. You have the great taking. You have brokers that, in order to save themselves, they have to take client funds, which is now legal. That's not, I mean, you can sue all you want, but you'll get thrown out of court because the laws read that your bank, your broker, your insurance company, your financial institution is the legal owner of what you think are your assets. They're your assets in name only. In other words, it's for the benefit of you, but the institution is the legal owner. So your institution gets into a problem, they're going to take your funds. The great taking is 100% real, and I believe it's 100% going to happen. So you've got to get out of the system. You've got to get your capital out of the system. If you think I'm crazy, only take 10% or 20% of your capital out of the system. At least you'll have something. Yeah, they can't print gold, they can't print silver, they can't print wheat, they can't print real assets. They can only print more contracts. And this is it's a problem of their own making over many, many years. And when I say their own making, I mean, let's go back, 2 weeks ago, when silver took the $35 drop in one day. You didn't hear a peep out of COMEX other than, and we're going to raise your margin rates. That's the only thing you heard out of COMEX. What did you hear out of China? They shut down 6 entities. There was like 249 traders that were reprimanded. That when I say shut down the 6 entities, they're precluded from trading for the next 30 days. So they took some very real steps against egregious naked short selling. Here in the United States, the CFTC, you didn't hear a word. Yeah, and that you can expect that to happen in all markets at some point. When things are completely breaking, what do you think they're going to do? They're going to pull the plug out of the wall, make everything go dark.
What does this mean for investors? First, volatility is likely to remain elevated as physical supply constraints collide with financial positioning. Second, diversification into tangible assets may serve as a hedge against systemic risk, particularly during periods of currency debasement. Real assets, from energy to agriculture to precious metals, cannot be created by keystroke. While worst-case scenarios such as exchange defaults remain uncertain, the underlying pressures of supply deficits and credit fragility are measurable realities. In times of structural transition, resilience often belongs to those holding assets grounded in physical value rather than promises.